What's up, you guys? This is episode 7 on the Untitled Book Club Podcast. Wait, the Untitled Podcast, because we're no longer doing books, but we're doing topics. And we're going to introduce today's topic momentarily, but first, let's introduce ourselves. My name is Terrance Reynolds, and this is...
Page Flipper. Hello, guys. Our contact information will be in the description if you want to follow us on Instagram.
Yes. And Paige, would you like to introduce today's topic?
Sure. So we're going to be talking about investing. So we're getting into the nitty gritty. What is investing? How do we do it? Etc. So it should be a fun conversation. If you like making money, that is.
Absolutely. And I love making money. But before we begin, I have always wanted to say this. This is not financial advice. This content is strictly for educational purposes only. And we're only talking about our experiences. Before you buy or sell any asset or security, please consult with a financial advisor. We are just two random people on the internet, and we cannot be held responsible for the decisions that you as an adult make. So let's begin. Paige, take it away.
Yeah, so we're going to do a little bit of role playing for this one, which is a little bit different for us, so bear with us. And so Terrance is going to be our viewer. Terrance is really great. Terrance has been investing since he was 20, so he's very knowledgeable about investing. But for the purpose of this content, for the flow, he's going to pretend like he doesn't know anything. So
I don't know anything at all. Nothing at all. I don't even understand money.
Like, what is money? How does it work? Paper.
Yes. And we think this is the best way to go about it because we don't know where our viewers are starting off at. So we're going to start from ground zero and get into it. So, Paige, as a new person, let's just say I have a job, right? And I have a little bit of money. I have savings saved up, and someone keeps telling me about stocks. I see all the stuff that is happening on the Reddit. I heard about earlier this year what's happening on Robinhood, and I want to get into stocks. But first off, I don't even know what a stock is. Paige, can you tell me what is a stock?
Yes. So, Terrance, a stock is a share of a company. So when you buy stocks, you own a small portion of a company. So if you were to buy Apple stock, I don't know how many shares there are Apple, but let's just say there's a million shares of Apple. If you buy a single piece or a single stock of Apple or a single share of Apple, you have 1 out of a million. You have a 1 millionth ownership of Apple. It's important to, when you're buying or when you're thinking about buying stock, is to also look at the volume, because every company has a volume of stock, which is how many shares of stock they have.
Okay. So I can buy a share of Apple, but how do I buy a share of Apple? Do I call the CEO of Apple directly? Do I go to the Apple store and purchase Apple's stock? How does this work?
Yeah, so when you want to buy some stock, the first thing that you should do is open a brokerage account of sort. Or you could go into one of the apps like Webull or Robinhood. I personally, this is my personal opinion, I prefer to have a brokerage account. I use Fidelity, but there's also Schwab as well as Morgan Stanley out there, and probably a few others that I'm not too familiar with. But if you're a person that wants to get a little bit deeper into investing, what you can do is get a Fidelity, a Schwab, or a Morgan Stanley account, which you go online. You can do this all online. You go to their website, and there's an option to open an account. And then from there, it's really like a 5-minute process. It doesn't take long at all to open a brokerage account.
Okay, so let's say I open up a brokerage account. I purchase my first share of Apple. Then what? What do I do with it? Do I get a piece of paper in the mail? What happens? Like, what happens next?
Yeah, so when you purchase, I want to take a step back and talk about the different types of purchases. So you could purchase at the beginning of the day. You could purchase at the end of the day, after hours, or something that's called a market order, which is when as soon as you put that order in, you purchase that stock. Because as the day goes on, the price of the stock is going to fluctuate. It's going to go up and down. It might drop and might rise. You always want to buy low, sell high. Don't time the market. We'll talk more about that later. But when you actually do go through the process and buy a stock, you will be able to see it in your account. So, for example, I have a Fidelity account and I have multiple individual accounts. And in my individual account, I can say, hey, for this particular account, that I might have. Let's say Apple costs $300. I don't know how much Apple costs right now. But let's just,
Okay.
that sounds rough ballpark. I can go onto my Fidelity account, go to that particular individual account, and then trade or buy a $300 piece of Apple. And once I receive that share, it will be posted to my account. So I can visibly see all of the shares of stock that I have in a particular account.
Okay. So I can buy a share of Apple or any other company, and then I can open up my app and I can see all of the companies that I own. Now, you mentioned earlier about the price going up and down, and me as a beginner investor, that sounds a bit risky. Like I saw what's going on with GameStop, and the stock just kept going up and then going down, and that makes me really nervous. Why should I invest into stocks and not just hold on to cash?
Good question. So cash depreciates over time. If you have $20,000 in the bank this year, that $20,000 is not going to be worth $20,000 a year from now because of inflation. And usually when you have something in a savings account, let's say $20,000 in the savings account, you will receive, depending on your bank, you might receive some type of interest on whatever you have in your savings account. But usually that interest is below inflation. Mm-hmm. So for example, if inflation is 2% and you're only getting 1.5% in interest in your savings account, well, technically you lost 0.5%.
Okay.
So with that being said, when you put things into the stock market, and there's a caveat to this because you want to make sure you're doing your research, you understand the company you're buying in, and I'll go a little bit deeper into that. But if you do proper research and you are not trying to time the market, which is what a lot of folks were doing. We saw with the Wall Street bets. You buy GameStop and then you're trying to time it for when it's going to be at this peak. And a lot of people end up losing money. A lot of people made money, but a lot of people lost money too because they're trying to time the market.
Yeah.
So when you put money into the stock market, over time, it will fluctuate, but long term, it's going to grow, especially if you're doing your research and you're picking companies or you're diversifying. Your chances of that money growing above interest or above inflation increases. So case in point, I'll give a case in point. I started Microsoft in 2019, right? And
You
part
started
of
buying Microsoft.
so I started my job
Okay.
at Microsoft in 2019. But when I started, I had a sign-on, like you get a sign-on bonus, and they gave me a particular amount of money in Microsoft stock, right? So let's just say so this is 2019. So back in 2019, when Microsoft granted me a lump sum of stock, which I get a little bit every year for the next 5 years. Well, the 5 years from 2019. But when I first got my Microsoft stock, guess how much that stock was worth in 2019?
$100 maybe? I don't know.
Around $149. You were pretty close. It was $149. Microsoft now is like $280.
Whoa. Wow. So you're telling me that if I invest into any company, I'm going to make that much money?
No, not any company though. So
Okay.
that's why research is super important. You want to look at things like there's things called 10K forms, which they show you
What's
the
that?
health. So a 10K form is a document that companies put out annually that shows the health of the company. So you're able to see income statements, balance sheets, and we're not going to get too much into that for this episode because it's going to go really deep. But once you learn how to read 10K forms, you understand balance sheets, income statements, cash flow. You're able to assess, and there's a whole bunch of ratios that investors use. You're able to assess the health of a company and have an idea of the projection for how much their stock is going to be worth. Okay. Another thing that you can do is look at trends. Over time, has this company grown, or over the last 10 years, have they decreased?
Wow.
With that, it's important to look at news. Look at and be familiar with the industry. So if you know nothing about automotives, for example, you probably don't want to start investing willy-nilly in a whole bunch of car companies if you don't know what's going on in that car industry or in the automotive industry. So research is imperative to making sure that you are, and that's if you're buying individual stock. But one thing that you could do if you're not comfortable, because that can be overwhelming buying individual stocks and researching individual companies, you can buy things that's called ETFs, which is an extended traded fund, or exchange traded fund, sorry. And that is, when you buy this, you buy one ETF, and in that side of that ETF there's a whole bunch of different companies. So by diversifying and having multiple companies by buying ETFs instead of individual stocks, not only do you not have to do as much research, but on top of that you have a higher chance of making some money because there's a whole bunch of different companies that are in that fund. Does that make sense?
I think so. When you first started explaining it to me, you were telling me about like 10K forms and ratios and like research. And to be honest, I'm just a programmer, so I don't really have any experience doing any of this. So to hear you speak about this idea of an ETF, you said it's like a basket of different stocks. Who creates this basket?
Yeah, so it's usually different. I guess I don't know what to call them, but for instance, I have ARK, ARKK. This is a portfolio of stock that was created by this woman in her company. And so there's like investing, I want to call them gurus, so to speak, that put these portfolios together on your behalf. Okay. And then you buy them. So ARK has a whole bunch of different type of portfolios. So if you're interested in technology, they have a technology portfolio where it's diversified in technology. They even have some portfolios with Bitcoin in them. And these are, I know a lot of people want Bitcoin right now, but like these are portfolios that are put together by experts. So you don't have to do all the research. They do the research on your behalf. The only thing I would suggest is making sure that you at least do a little research on whatever ETF that you're looking into.
So I have a question for you, Paige. These professionals, when I purchase an ETF and they invest on my behalf in those baskets of companies, are they doing this for free?
I wish they were. So they're going to take a fee off the top. And this fee is going to go towards operational costs for providing you a service.
Okay, so we have stocks, ETFs. Is there any other like investment types that I should be aware of?
Yeah, so there's index funds, which is a mutual fund, which is similar to a ETF, but we're not going to get into too much detail about these. There's also bonds, and people also invest in real estate, or they invest in if they're trying to create a business, that can be a form of an investment, trying to make your own business. So there's multiple ways that you can invest, but these are the ones that are quite common. And maybe in a future episode, we can go into deeper detail, but not today.
Okay, so you're telling me all this information. I understand that my money is decreasing over time if I keep it in a account, like a savings account. I understand the different types of investing, at least I'm aware of it. But when am I going to do all this information next?
Yeah, so with this information, you can set goals for yourself depending on where you would like to be. So some people invest for retirement. And if you're investing for retirement, there's 401k plans, there's Roth IRAs, and there's traditional Roths. Again, we won't get into too much detail about that. But there's multiple ways for you to invest for retirement. So that way when you are old and wanting to live your best life without working, you can. And you'll be able to live comfortably. Hopefully, that's the goal with retirement. Something else that people invest for, or, the reason they might want to invest is for college. So there's plans that you can, like the 529 plan, where you can put your money into a college fund. So that way you can use that towards college. Okay. People sometimes invest for growth. Just, maybe you just want to have the money. And there's also an idea called legacy. People buy real estate sometimes, and I'm pretty sure you've heard of this, buying real estate and passing it down to your offspring or to your grandchildren. So with this information, you can, one, set a goal and use investing as a means to get to that end goal, whatever that goal may be.
Cool. Now, but I am a bit nervous, to be honest, because I've seen like the older people in my family invest for retirement, but then the 2008 crisis happened, and then like the financial markets kind of collapse. Is my money safe? Like if I'm putting it into the retirement fund for such a long time?
So, when you're investing, there's always a level of risk. Some types of investing is more risky than others. So, it's important to understand how risk averse you are and then plan on investing in funds that are less risk averse versus, for instance, you wouldn't want to put all of your money into one singular company because that's very risky. If that company goes bad, your money is gone. And when you have plans like 401k plans or Roth IRA plans, there's a concept called diversification, which is in the process of diversification, not only are you investing in the US market, but you can also invest in other foreign markets. So you have the domestic, which is US, and you also have foreign markets. And then you're also investing in different index funds, different ETFs, and different types of companies. So if you are very nervous about investing or putting your money away for retirement for a long period of time, something that you can do is make sure that you have diversification in your portfolio.
Diversification. Okay. This is a lot to take in. Is there anything else I should be aware of?
Yeah, so I just want to give some few tips and some things you should know, and kind of circle back on a few things. Number one, please research. And if you don't want to research individual companies, ETFs, index funds, or other ways to go. But also make sure that you're researching what those fees are when you're buying those types of stock. The second thing is diversify. So be in different industries. So be, whether that's tech, medicine, automotive, cosmetics, pharmaceutical, whatever. But then also be in other markets such as domestic versus foreign markets. Buy low, sell high. So when you buy a stock, of course, if you're planning on selling it, you probably want to sell it when it's at a higher price, but don't try to time the market.
Time the market.
Yeah. So, I'm not going to lie. I drank some of the Wall Street bets, whatever. That was complete gambling. So I want to touch on this real quick. So you got the Wall Street bets thing where you had AMC and GameStop. And what people were doing were trying to time the market. They were trying to buy it low and sell high in a short span of time without doing any research about what these two, it made no sense. I am one of those people that bought both stocks only because this was a gamble. I looked at this as gambling money. I don't go to the casino often, but I'm like, this is a legit risky, volatile gamble. So don't try to time the market. If you're gonna try to time the market, make sure you're able. It's like, think of it as a gamble and that you're willing to lose the money.
I don't know, Paige. Like I saw earlier this year, a lot of people made tons of money on this. Like I think there's this app called Reddit and like Robinhood, and people are like organizing themselves with this GameStop thing. And I seen like some portfolios go from like 1,000 to like tens of thousands of dollars. Why shouldn't I gamble with the stock market?
So sure, there's going to be some winners, but there's also going to be some losers because GameStop and AMC, no shade towards the companies, they weren't doing well. And so as you are buying up all these volumes of stock, as people start to sell their stocks, those people who have a whole bunch and they're selling a lot, the price is going to start to plummet. And if you don't sell at the right time, you're going to be stuck with a stock that was worth less than when you purchased it. So that's really why you don't want to time the market. You want to actually invest in companies that are long-term going to increase in value, not something that you're not sure what the value is even is. I'm not going to lie. I lost money on GameStop, but I didn't lose anything I couldn't afford because I looked at it as a gamble. And I played with it like it was at the casino. I'm not saying that y'all should do this. Again, we're not financial advisors. Just want to say this. I'm not saying you should do this. But I don't gamble. I don't go to the casino. So I was like, why not? Why not see what this is about? But it's an irresponsible thing to do, in my opinion.
Wow. Thank you for the information, Paige. Is there anything else I should be aware of before I begin investing?
Yeah, so there's some other concepts that you could learn about before investing, but this is a good primer for first-time investors to get you started investing. There are some other resources that you can use. There's great YouTube channels, but there's also some books I'd like to introduce. We have Women with Money. I referenced it earlier in the podcast. It's something that I read. This applies to men too, by the way. But it talks about investing, and it's just an amazing book. I read it. I highly recommend it. The second book that I like to talk about is Why Stock Go Up and Down. This is a hefty book, so you don't have to read everything in this book, but there's a table of contents that has some really good information, so you can kind of parse through the book and get what you need when you need it. But no, other than that, I say if you are curious about investing, keep being curious. Look for content. There's a lot of great YouTubers. There's great resources and books. And yeah, this is just a primer to get started.
And scene. Okay, so I'm no longer the student anymore. I'm the co-host, Terrance Reynolds, and I'm back. I would like to thank you guys for listening to this month's episode of the Untitled Podcast. This month's episode, as you know, is about investing. Next month's episode will be another special topic that we introduce then. So, Paige, do you have any last remarks?
No, just thank you everyone for watching and tuning in. Excited to see you next month.
Okay, so see you next month and goodbye.
Bye.